This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The Strait remains closed. Oil is at new highs. The Fed remains in neutral, but the news of the week was CapEx and return on investment. I'll try to illustrate what a winner looks like in this race on this week's Wise Investor Show. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. We had a lot going on in the capital markets this week. We had a Fed meeting. It's the last one with Jerome Powell was the chair. We had the ongoing troubles in the Middle East with the Strait of Hormuz still closed and oil now making new highs. And the real market movers were the earnings results for some of the biggest concentrated positions in the S&P 500, those so-called hyperscalers. And I'll get back to the latter in a moment. But first with the Fed, which really didn't move the markets much on its own. But as expected, they kept rates unchanged this week, but they finished this meeting with 4 dissenting votes. And that's the first time that there's been 4 dissents in almost 30 years. But while that means it could be said that it reflects a divided Fed, the dissents weren't all themselves all pointing in the same direction. They're not all pushing for a cut right now, and they removed from the announcement the previous language, which was that the Fed had an easing bias. Coming into this year, there were forecasts for at least 2, many forecasting for at least 3 rate cuts. Now it's down to a 20% chance in the markets for one more rate cut this year. We'll see what happens when we get a new chair and some new blood next month. Powell said in his final press conference after the release that inflation has moved up, which he said was largely reflecting the change in global energy prices. But we also received the PCE inflation data the next day on Thursday morning, and it showed PCE at 3.5% year over year, 0.66% for the month of March, with the core stripping out oil and food costs up 3.2% year over year and 0.29% for March, suggesting inflation running well above 3%, even without those higher oil costs, and well above the Fed's stated goal of 2% inflation. Now, Powell emphasized that the developments in the Middle East are contributing to both inflation and the strength of the economy and unemployment. And again, we got data this week somewhat contradicting that, where initial jobless claims were lower than expected. Wage growth accelerated over the previous period and still ahead of those inflation rates. And Powell went on to say in his conference that, quote, consumer spending has been resilient and business fixed investment has continued to expand at a brisk pace, end quote. And there was evidence of that, too, on Thursday morning, as first quarter GDP results were up 2.7%, versus the consensus on FactSet of 3% on the initial print for the period. And it's an improvement over the fourth quarter last year. We had growth of 2%. But note that half of the growth in the economy for this quarter is directly attributable to AI spending. So it continues to appear the economy is growing, driven largely by the AI boom, and it would be pretty soft without that component, and unemployment remains stable, although the overall labor force is being reduced by a large drop-off in immigration, as well as a drop in the participation rate. Now, the participation rate, it's not a perfect reading of what the labor force is doing. It includes everyone in the United States who is 16 years old or over. So folks in their 80s and 90s are included in that count. And while it's interesting to note that measure when you look at it as a period over period reading, it's going to be really compelling to watch what happens to it over the next few years as we continue to feel this kind of tidal wave of baby boomers retiring and still, though, being retired, being counted in that participation rate, while it should be counterbalanced by the millennials and the Gen Zers and so forth. But if there's a real negative impact of AI unemployment, and it seems like people are finding it harder to find new jobs, that's where you're going to see it showing up. As I mentioned, Powell said that the consumer has been resilient and recent measures of consumer confidence have remained above expectations, despite the headlines and higher costs at the gas pump. But consumer spending, while growing, isn't the engine today it's been in the recent past. According to the Wall Street Journal this week, consumer spending rose 1.6% in the first quarter. That's well below the inflation rate because the spending is adjusted for that. And despite higher wages, which should lead theoretically to higher spending, which is also slower than the previous quarter, but businesses in the U.S. with their fixed investments are rising more than 10% in the quarter, which is that reflection of all that AI spending. The journal went on to point out that consumer spending constitutes roughly 70% of GDP. So the economy can't afford it to roll over completely. The economy would be in pretty bad shape, maybe bouncing off negative growth if we didn't have it. But as I mentioned, in the data that was also announced this week, consumer confidence actually improved in April versus the March reading, and it exceeded the estimates in FactSet. But what was most notable this week and what powered the indexes higher on Thursday was the results from some of the big tech names, which I'll get into in detail after the break, but especially the spending expectations that they shared, that they included there in their quarterly results. Now, I'm going to get into some more details on the results later on and once again share my disclosure statements, but as I mentioned some of the details here, note that these are companies that I own personally and we own for our clients, so while the facts are what they are, the impression that I leave here is shaped from a positive bias on these names. Starting off, Amazon reiterated their expectations to spend $200 billion this year, largely on expanding their efforts in AI. And looking at FactSet's estimate for their EBITDA, which is earnings before interest, taxes, and amortization, they're expected to bring in about $197 billion, which leaves them with a slightly negative free cash flow for the year. For what it's worth, the forward estimates don't include similar expenditures for Amazon, but it's projected to take 3 years from now before they generate over $100 billion in free cash flow again, versus their current market cap, which values them at almost $3 trillion today. Stock initially reacted well to these reports. It hit new all-time highs. But with that spend in place, it can be a bit tenuous if their sales in the coming quarters and years cannot generate that EBITDA and ultimately free cash flow in order to prove that it's a worthy return on these huge investments they're making. Google's parent company, Alphabet, they updated their 2026 capex to $190 billion, with the CFO also adding that they expect the spending to then, quote, significantly increase, end quote, in 2027. They too made all-time highs on Thursday, with the total market cap trading well over $4 trillion, and their EBITDA for the year is estimated at $227 billion, and their free cash flow is at only $25 billion. And the average estimates on FactSet show that CapEx is expected to continue, actually compounding higher above this level for the next 4 years. But they also estimate that the free cash flow levels, which were $73 billion in 2025, they expect it to return to close to $100 billion in 2028, and then go on to double to over $200 billion by 2030. Lastly, in this trilogy here, Microsoft is set to spend $190 billion this year, noting themselves that $25 billion of that is an impact from the higher component prices in these efforts, all of which is substantially higher than the estimates, which were for them to spend $136 billion this year versus the $89 billion capex last year. They were also expected to generate $53 billion in free cash flow this year, and I know I'm throwing a lot of numbers at you right here, but that $55 billion estimate is down from $70 billion last year. The difference there between the two reflecting the higher spend minus actual growth above it. And if you go on to then subtract the higher spending that was announced in this quarterly report, those estimates I gave, which were as of yesterday, they're actually going to be, at best, roughly cash flow neutral for this year. And while the spend is projected to also continue at this rate, their free cash flow, which might have to be updated, and I'll have to reflect back on that in the coming days as the numbers and facts that are updated, but their free cash flow as of yesterday was expected to return to over $100 billion by 2029. But that's going to be, of course, dependent on not just a return on all this investment, but if they continue to spend hundreds of billions of dollars a year, or if they can let it ride at some point. And, these guys aren't alone. The total spend is massive in the economy and evident in these economic reports, benefiting those that are receiving the revenues, that are taking the sales orders from all this spend. But what remains to be seen is how much return and revenue will all these names really receive over the next 10 years, say, from all this investment. And when will the free cash flow reflect a reasonable return on the valuation that many of them are garnering today? If you're spending $3 trillion, $4 trillion on the company in whatever share quantity you are, you need to see a return on that, basically on the version of future free cash flow. All right, I'm going to slip into a quick break here, but when I return, I'll do a deeper dive further into the details of these quarterly reports. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back in a moment.
Midterm election years are almost always the most volatile, and so far 2026 is proving no exception. Will you let the inevitable churn in your political leanings disrupt your plan and portfolio? Tune in every week as we discuss the latest financial trends and what investors need to know. To avoid the endless barrage of distractions and become a better informed, wise investor, listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James & Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show, and sorry for the gobbledygook of numbers over numbers over numbers, but cobbled together, if you can get your mind around it, it really does start to paint a picture, some good and some bad. Let's circle back first to Alphabet once again, who at this time, when I came in here to record, was making new all-time highs in the market. And as I promised, I will remind you that I own these stocks and we own them for our clients. So bear in mind, while you're listening, don't make decisions based solely on what you hear on this show. Google, and I'm going to go back for my own convenience to calling them Google instead of Alphabet, they reported earnings for the quarter of $5.11 a share, well better than the estimates, and what they earned last year, the same quarter, $2.81. And it was thought at some point, about a year ago, Google was actually struggling for a period there as a stock. The thought was that all this AI creation may doom Google's core search business on the internet, that AI would replace it essentially. But it appears that the opposite could be true. Google's management said on the call, quote, 2026 is off to a terrific start. Our AI investments and full stack approach are lightening up every part of the business. Search has a strong quarter with AI experiences driving usage, queries at an all-time high, and 19% revenue growth, end quote. Now, Google's cloud business also saw tremendous growth. They had 63% growth for the quarter, and their backlog within Google Cloud nearly doubled just over the previous quarter. Their CFO also went on to say that Waymo, and that's their autonomous car service, soon to be on streets near you, they're actually now surpassing 500,000 autonomous rides provided each week. It's also worth noting that YouTube, and YouTube is now the most highly used streaming service out there, they saw ad revenue for the quarter of $9.88 billion, which was actually below the estimates of just under $10 billion. Also, their stated free cash flow for the quarter was a little over $10 billion versus the estimates on FactSet, which were closer to $12 billion. Regardless of a couple of those shortcomings, though, the focus of Wall Street and the markets and what appears to be driving the stock higher was on the results in search revenues and the cloud business. And an analyst over at Deutsche Bank said that he, quote, credits AI features for search growth, with more than 30% of ad search spend being AI-enabled, given improved advertising applications and small strides in identifying commercial adjacent queries could be a material opportunity, end quote. He also said the doubling of the cloud backlog was impressive, which may be obvious, but he thinks, quote, the full-stack vertically integrated approach is a key selling point, end quote. And that's kind of, I guess, what's setting Google apart from their peers at the moment. That analyst raised his price target and maintained a buy rating. Over at D.A. Davidson, their analyst noted the consumer AI adoption is the strongest that they've seen, with paid subscriptions now reaching 350 million subscribers on the combined YouTube and Google One services. And at Goldman Sachs, their analyst, in addition to repeating more of the same of what I just said, also pointed out that revenue from products built on Google's AI models grew nearly 800% year over year. Now, AI is still kind of early in the game. I guess I have to stop saying that soon, but I think we're still in the early innings of the deployment. So a year-over-year comparison can be misleading. I mean, it's great, but it's building off a small base. 800% off a small base is easier than 800% off a long-established business. So that enormous growth is really a reflection of it just getting ramped up. But in contrast with some other tech names, Google does appear to be demonstrating a successful monetization and this return on investments. So the stock is being rewarded when the markets are getting tired of a wait-and-see approach with some other companies out there. Speaking of which, Amazon reported earnings of $2.78 a share on revenues of $182 billion versus the estimates, which were for $177 billion for the quarter. That company also guided for the current quarter to see revenues almost $200 billion versus the previous estimates and guidance they gave of $189 billion. And unlike what I said a moment ago regarding Google's AI growing off that small base, discounting the year-over-year consideration, Amazon's CEO said, quote, AWS is growing 28%, our fastest growth in 15 quarters on a very large base, end quote. So their Amazon Web Services business is accelerating here. He also pointed out to successes in their chip business, their advertising, their stores, which saw the highest rate of growth since the COVID lockdowns, back when we were all stuck in our houses and only shopping online. And then he pointed out to the success of the movie Project Hail Mary. I would actually highly recommend the book. I haven't seen the movie yet, but I didn't realize that Amazon was the distributor for that movie. And he went on to say that it was the second most successful non-sequel, non-franchise opening in recent memory. I'm not sure what that time period is, but they took in $615 million at the box office, which is maybe small potatoes compared to the rest of the revenues, but pretty good for a movie opening these days. At Barclays, their report on the earnings pointed to Amazon's accelerating growth, but also expanding operating margins across all segments of their business. He says, quote, he remains bullish and sees shares finally reflecting the company's strong positioning with upward momentum expected to continue, end quote. He raised his price target to $330 a share and maintained it overweight. In a bit of a mixed message over at KeyBank, their analyst said he, quote, believes AWS reacceleration continues to be intact, with material quarter-over-quarter backlog growth more than offsetting the modest shortfall against the 30% growth seen in the first quarter. He, too, raised his price target to $330 and maintained it overweight. And at Goldman Sachs, they said the report included several key themes, including revenue exceeding the company's own guidance, operating income, which beat the Goldman Sachs estimate by 15%, and above the own company's guidance again, and the revenue backlog growth at AWS, framing the opportunity and bringing transparency to the future growth. They also said that, quote, management emphasized the corporate history of investing capital ahead of large market opportunities when the company has strong signal around the demand curve, which should leave investors less concerned about return on investment from the current spending levels, end quote. And that's the theme and takeaway for this week. And beyond the headlines of the war and inflation and monetary policy, there are a lot of other questions out there about all of this CapEx, which is such a key component of our overall economy today. But the winners now maybe more clearly than ever, are those that are, one, benefiting from the CapEx, those that are selling into it, providing the supplies into that spend, and also those now that are demonstrating some return on that investment. They may be few and far between at the moment, and it remains to be seen. Maybe it's a club that expands over the next couple of years, or if it remains a pretty exclusive club with a select few winners and a bunch of other businesses left with their cash exhausted, their balance sheets ruined, and their businesses falling far behind. That's the lasting question for many quarters to come. But for the results like the companies I mentioned today, they at least are showing that they're seeing some success and potentially lasting success in that space. All right, that's all I got this week. I hope it brought some perspectives for you. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.